you recently upgraded EM credit. What was behind that decision?
Yeah, thanks. So there were a couple of things that we and our emerging market team are looking at. One is that the yield pickup to emerging market credit had really lagged the improvement we've seen in equities and developed market bonds. I think, secondly, more confidence that the global economy did bottom in April, and that growth is picking up, and that ultimately does help and will mean that maybe the economic damage in EM is not as bad as initially thought. And third is, as you correctly just mentioned, that maybe some of the technical factors are looking a little bit better, that fund outflows are slowing and potentially reversing. And, a lot of the indicators that our emerging market strategists follow suggest quite a bit of caution among EM investors. Cash balances are very high. Investors are relatively cautious on the amount of beta they're taking. So I think we put all those things together and think that the risk-reward is favorable in EM credit and moved it to overweight.
Okay, interesting. And on the dollar bonds as well, I mean, we talked about the fact that the extra yield over treasuries is dropping, but it still remains 23% above its lifetime average. So that does suggest potential further bond gains once the virus is contained. But Andrew, earlier we were talking about the potential of a repricing of geopolitical risk, particularly with regard to US and China. And a lot of people flag this as a big risk for emerging markets. Is that something you'll keep a close eye on and perhaps reassess the overweight in the autumn?
It is something we need to keep an eye on, and very much to that point, I do think that maybe the greatest pressure point or risk point to the market could sit in August and September, where you have the confluence of the approaching U.S. election, maybe greater temptation for more hawkish China policy. If we see a second wave of cases in the U.S. From coronavirus, we think also that timing is potentially when it could happen. But I also think for emerging markets, there is a difference between the credit and the equity here. I think equity markets are probably more susceptible to uncertainty over just how fast the recovery is. Do you see further trade tensions that impact earnings? I think the credit space, the fixed income side of emerging markets, will be less sensitive, I think, at the margin to those trade tensions. And indeed, I think that's what we saw, if we look back to 2018 and 2019 as well, that the equity side was more affected than the credit side. So that's a bit of the way we're thinking about that.
Yeah, still on the credit, though, Andrew, given that you've said some of it is predicated on a growth recovery or growth perhaps not being as bad as some expect, is it more China that you're positive on in that EM credit space rather than, for example, LATAM?
Well, I think within LATAM, I think we are seeing some signs that maybe there's enough negativity that's in the price. We had been, for example, more bearish on the Brazilian real. We've moved that to neutral. We've moved to a positive recently, to a positive view on the Mexican peso. Again, not that all is clear in these economies, but that I think market sentiment had moved a lot and moved to be quite negative. Even as in the case of Mexico, the economy is very linked to the United States, and the U.S. data does look like it bottomed in April and will improve from here. So even in LATAM, there are certainly some places where we think the risk reward is now favorable.